Don't put all your eggs in one basket. Diversification is a very popular word in investment terminology. It is an appealing principle, as all investments carry with them some form of risk. But a way to reduce exposure to that risk is to have other investments in other asset classes that would not be exposed to some of the same risks. For example, owning a property in Ryde and another property in a different market, say Parramatta or be it interstate. Having a stock portfolio as well as being invested in index funds. If looking at compounding growth, for many the appeal of index funds or real estate investment trusts have a boring but steady low risk approach, achieved by gaining a cross-section of a market and riding the natural average growth over time. This can often outperform other means of investing that are more volatile. In property in places like Sydney, there are some incredibly robust markets, but there is a major tendency for investors to mainly look to an area they have lived in or are personally familiar with. That being said, one of Warren Buffett's famous lines is, "Diversification is protection against ignorance. It makes little sense if you know what you are doing." What this means is that diversification is less important as your knowledge is increased. But if you're not a professional investor, then diversification is more likely to be a relevant strategy for you. The best investments are the ones you understand. Properties are expensive, normally bought after disciplined savings and hard work. It's never worth betting that time and financial investment completely on someone else's knowledge. Education is an insurance policy against getting misled. Having some understanding of how you're investing is vital to reducing stress and risk, and devising a strategy helps to make everything clearer. Whether it be stocks, property, business, art, or anything else, the more knowledge an investor has on the investment tool, the greater potential return they can achieve. For example, think about the difference between Warren Buffett and Richard Branson. Branson is an entrepreneur gifted at investing in his businesses, whereas Buffett is the most celebrated investor in the share or stock market. They have different skills, and they've learnt more and more about how to get great returns in their respective field. So look at some of Virgin's wacky launch campaigns and Branson's publicity stunts. Can you see Buffett doing this? On the flip side, it's unlikely that Branson could match Buffett's value investing. So these famous investors don't need to diversify necessarily because they understand their particular niche so well. The question we often ask is, what? As in, what to invest in or where? But the question great investors ask is how? How to get the best results in what I'm doing. That involves building skill and knowledge. Reduce reliance on speculation. Don't invest in assets with an overly speculative upside to them unless protecting against that risk by purchasing at or below the fair market value of a property. For example, a house worth $1 million in Smithville is offered to you and the agent suggests that there is a rumour that a new train line will be running through, around 500 metres from the property. It'd be foolish to pay overs just to secure the property because at any time, these plans could be abolished and reorganised or delayed. If the property can be secured for $1 million and has decent capital growth prospects, regardless of the train line speculation, then hopefully on a rainy day, a worst case scenario, it can be resold at the market price. Some small capital gains might be worthwhile and offset the selling expenses. If acquired for $900,000, there is even more value and a risk buffer of sorts. Although don't forget the risk that the line could run straight through the property. Stress of investment. Looking over the earlier principles will highlight the importance of goal and strategy setting. Your goal or goals can be anything, but they must be as personal, specific, and clear as possible. If you have lifestyle goals, then it does not make sense to invest in a way that creates more stress than a return is worth. Financial return is meaningless without the capacity to enjoy it, and so determining the stress of investment is majorly important. Hopefully you have found some worthwhile concepts and ideas to apply from this lesson. The important thing to grasp is how your goals, capacity for risk, and personality fit in with how you are going to make decisions around investing. We look forward to building on this platform in following modules with more technical insights. Hello everyone, thanks for tuning in to the Sydney Listings Academy. Just a quick disclaimer that this advice is generic and is not to be used by individuals. We take no liability for misuse of this information and encourage you to seek out professional advice specific to your situation. Please reach out to get in touch with our network of trusted professionals if you so need it. And just before you take off, just a quick note, obviously we're working on something with the Sydney Listings Academy to help educate people about the potential in property, finance and investing. So if you want to support the Sydney Listings Academy, please share the content with friends, family and followers if you have them, and also follow Sydney Listings on Facebook, Instagram, LinkedIn, and or YouTube, wherever you like to hang out, as well as our website, and check that out for more resources as well. Thank you very much, guys, and we'll see you in the next video.